All right, so today we're talking about the Federal Reserve, interest rates, inflation, and basically everything that's going on with the US economy. The Wall Street Journal published an article yesterday breaking down the Fed's latest decision about rate cuts, and honestly, there's quite a bit to unpack here. So let's go through the key points and break down what they mean. Then I want to transition into kind of a more broad discussion on what exactly the Federal Reserve does and why it's so crucial to the US economy. If you've ever wondered why the Federal Reserve makes the decisions it does, or why they don't seem to care who's in the White House, I hope we can clear some of that up today. So, starting with this article from the Wall Street Journal. The Federal Reserve, and I'm just going to call them the Fed from now on, they've decided to keep interest rates steady at around 4.3%. So, no immediate cuts, but also no hikes, just holding. Now, that might seem like a bit of a nothing burger, but there's actually a lot of significance here. The Fed isn't just keeping rates where they are for fun, they're responding to some pretty major economic signals. So, first things first, inflation expectations are on the rise. Back in January, the Fed projected inflation to be around 2.5% this year, but now they've revised that up to 2.7%. That might not seem like a huge jump, but in the world of central banking, that's pretty meaningful. So, what caused this change? Well, the answer is simple: tariffs. The Trump administration shows no signs of letting up on all this tariff business, and the Fed recognizes that this has the potential to push up prices on certain goods. And when prices start going up, businesses and consumers alike start expecting inflation to stay high, which can actually cause it to become a bit of a self-fulfilling prophecy. At the same time as all of this, GDP growth expectations have been revised down from 2.1% to 1.7%. In other words, the Fed thinks that the economy is slowing down. Unemployment forecasts are also slightly worse, suggesting that businesses might be hiring at a slower pace than previously thought. Overall, the Fed is walking a very fine line here. They don't want to cut rates too soon and risk undoing the progress they've made in bringing inflation down since 2022, but they also don't want to keep rates too high for too long and risk pushing the economy into a recession. This is a classic monetary policy balancing act between inflation and growth. Another interesting development is their decision to slow down the reduction of their asset holdings. Right now, the Fed holds a massive $6.8 trillion portfolio of assets, which includes Treasury securities and mortgage-backed securities. These are basically just investments the Fed has made over time to help stabilize the economy. But over the last couple years, they've been gradually selling off these assets or allowing them to mature without reinvesting, which is a process known as quantitative tightening. So why were they doing this? Well, when the Fed holds on to too many assets, it injects money into the economy and increases liquidity. While that can be helpful in times of economic distress, too much money sloshing around can also lead to higher inflation rates. By shrinking its balance sheet through quantitative tightening, the Fed effectively reduces the money supply, helping to keep inflation under control. But now they're slowing down on this process. Instead of letting that $25 billion in Treasury securities mature each month, they're cutting it down to $5 billion. Why? Well, they don't want to disrupt financial markets too much, especially with all the uncertainty surrounding the federal debt limit. If they continue to reduce their holdings too aggressively, it could create an unintended ripple effect, like making it harder for banks to lend money or causing short-term interest rates to spike. Another way to think of this is to picture the Fed like a bartender at a crowded bar. If they pour too many drinks too fast, people might start making reckless financial decisions, which in this case, that would be inflation. But if they suddenly cut people off completely, the party dies and you have a lot of angry, partially drunk people. In that case, it'd be an economic slowdown. So right now, the Fed is trying to find a middle ground, easing up on the drink limit, but also keeping the party under control. In summary, the Fed is being cautious. Inflation isn't entirely under control, economic growth is slowing, and uncertainty about policy, particularly around tariffs, is making it hard for businesses to plan for the future. So it seems that the Fed is just trying to keep our ship steady in some pretty choppy waters. Now, all of this begs a bigger question. Why does the Federal Reserve have so much power over the economy? Why are we so focused on what they do? And most importantly, who are these people and why do they get to make these decisions? If you've ever wondered what the Fed actually does beyond just setting interest rates, we're going to talk about that right now. The Federal Reserve was created in 1913 in response to a series of financial panics that made it clear the US needed a central authority to help stabilize the banking system. Before the Fed, banking crises were a regular occurrence, and there was no coordinated effort to prevent them. Today, the Fed's main job is to manage the economy by controlling the money supply and interest rates. It has three main responsibilities. One that you've probably heard a lot of conversation around is monetary policy. This is the big one. The Fed uses interest rates and other tools to control inflation, encourage economic growth, and maintain employment to the best of their ability. When the economy is overheating and inflation is rising, they raise rates to cool things down. And when the economy is slowing and needs a boost, they cut rates to encourage borrowing and investment. The second responsibility is regulating banks. The Fed oversees and regulates banks to make sure they're operating safely and not taking excessive risks. This became especially important after the 2008 financial crisis, when it became clear that some banks were playing fast and loose with a lot of their risk taking. Their third responsibility is financial stability. The Fed acts as a lender of last resort during times of crisis. During the pandemic, for example, the Fed took aggressive action to stabilize financial markets and prevent total economic collapse here in the United States. But one of the most important things to understand about the Fed is that it is an independent institution. That means that unlike Congress or the presidency, the Fed doesn't answer to voters or elected officials. Their decisions are made based on economic data, not political pressure. And this is by design. The idea that monetary policy should be driven by long-term economic stability, not short-term political goals. If interest rate decisions were left up to politicians, you can imagine a world where rates were constantly being manipulated to win elections, rather than to keep inflation and growth in check. And for the most part, the system has worked. While the Fed has made mistakes, nobody's perfect, it's also played a key role in keeping the United States economy relatively stable for over a century. So to wrap this all up, the Fed's decision to hold rates steady reflects a complex balancing act. While it might be making people in and out of the financial industry feel a certain type of way, the bottom line is that inflation is still a concern, but so is slowing economic growth. The uncertainty around tariffs and other economic policies makes their job even harder. So whether you agree with their decisions or not, it's important to understand that the Fed's actions are based on economic data and not politics. Their job isn't to make politicians happy, it's to maintain economic stability. And as always, I'd love to hear your thoughts on all of this. Do you think the Fed is making the right call here? Should they be more aggressive with rate cuts, or is holding steady the right move right now? Feel free to leave a comment below. If you liked the video, please let me know by pressing the like and subscribe button. Thanks for watching, and until next time, have a good one.